Good afternoon. I'm John Klobasicki, Director of Wealth Management in Fairport Wealth's Harrisburg, Pennsylvania office. We're excited today to welcome all of our clients to this July's investment town hall. Based on your feedback, we've scheduled these webinars on a quarterly basis, and leaders from all of Fairport's office locations will take turns in moderating throughout the year. The goal of the town hall is to connect you directly with Chief Investment Officer John Silvas. He'll recap where we've been, describe where we are today, and share his thoughts on what's ahead. We've asked for your questions in advance, and John and his team have prepared slides addressing them and other frequently asked questions. Your advisors are in continuous contact with the investment team, and here are some ways that you can be too. Expect to receive timely Fairport perspective updates via your email. If you are interested in weekly updates, ask your advisor to share our market note on Tuesdays and Wednesdays. We've been sending those in Harrisburg regularly to our clients. So if you're not getting them and wish to, just reach out to us or reach out to your advisors anywhere in Fairport's regions. Subscribe to the Fairport Flash podcast on Apple Podcasts, Stitcher, or Google Play. Follow the hashtag investing with Fairport on LinkedIn for frequent thoughts on the markets and the economy. A few housekeeping items. Everybody will be muted for this webinar and your cameras will be disabled. If you have questions that arise, you can type them into the chat section of your toolbar and we'll answer as many as we can, time permitting. So with that, I'll turn it over to John Silvas, our Chief Investment Officer. John?
Thanks, John. How's the weather in central Pennsylvania?
It's hot. It's hot. No major storms, so all good.
Good. Well,
I
prefer the fall, but that's okay. I'm excited to get started. Obviously, we've had a pretty good first half of the year. Let's see if I can get this. So, and all joking aside, I don't know. I went back and looked at this today. The movie Terminator came out in 1984, so I was 14 years old. But the joke, he said, "I'll be back," and for the last 3 months, that's all you've been talking about: artificial intelligence and Chat GPT and all those things. But I think it's something we're going to be talking about for a lot. I've heard people say it's the next internet wave. I don't know if that's the case or not, but I definitely think my fear is my kids will start using it to write their term paper. So we'll see how it goes. But anyway, just kind of jumping right in here, kind of review the second quarter, but really going to review the first half of the year. And as we always kind of start off with what we call the periodic table, if you want to call it that. I think 2023 is turning out to be the consensus killer, and that's not my term. I borrowed that from somebody from Federated Investors. But if you go back to the beginning of the year or the end of 2022, there's a lot of things were happening. One, everybody was saying that value was going to continue to outperform growth, that technology was kind of dead, because it was a long duration asset. We were going to retest the lows in the first half. We were going to have a recession, most likely. Most economists said that. We had the debt ceiling coming up. That was going to be a major issue. We'd probably see some kind of pullback in the markets because of that. And really, none of those things happened. So, growth is beating value. Technology has been the leader this year. The debt ceiling, a little bit of drama came with that, but more or less we got right through that. Cooler heads prevailed, which was good. We haven't retested the lows. Most of the strategists out there, the Goldman Sachs, the JP Morgans, had about an average year-end target of 4,100 on the S&P. Today we're at 4,525, so we're obviously well above that. Most of them have raised their consensus estimates for the year-end. So pretty much anybody that came out with a pretty negative view at the beginning of the year has been kind of changing their tune. Not that we're out of the woods. I think there's a lot still to be worried about, but I think I would categorize us as kind of looking at the glass half full, not half empty. And one of the things I heard today, and John and I were talking about this before the call, that Larry Fink, the CEO of BlackRock, came out and said there's $7 trillion in money market out there. So there's a lot of cash still on the sidelines, that can be still invested in the market. So we'll see how that goes as we progress into the second half of the year. As far as equity markets, I think we've started a new bull market. Those things are always kind of open for interpretation. As you can see with the red circle there, off the October 12th low, we're up 24%. I actually went back and looked at it as of yesterday. We're up about 28.5%. So history would tell you by the time you get to that level, there's usually, bull market has been established. So we'll see how we play it out in the second half. The ACWI, which is the All Country World Index, which is a global benchmark, is up 29% from that low of October 12th. So it's not just a U.S.-driven market, equity market. And I think there'll be pullbacks as we go, but right now I think I'll give the benefit of the doubt. I actually looked it up today because there's always a different interpretation, but Investopedia, which is a pretty common website out there, defines a bull market of a rise of 20% or more. So we're well in that range. Strength begets strength sometimes. So if history holds, we should see a strong tailwind, strong tailwind into the end of the year. If you look in that blue box there to the right of the table, usually when you get a strong market, like we have a strong start to the market in the first 6 months, if you get between 12 and 17%, and we were up a little over 15, returns in the second half tend to be pretty good, about 10%. They tend to be positive the second half of the year. Actually, 100% of the time since 1950, they've been positive. So I'm not guaranteeing a 10% return or anything like that, but I think we kind of have, and again, it should be tailwind, kind of a tailwind to our back, and have a little bit of momentum. As I mentioned earlier, I don't know if we're going to enter what they call a FOMO moment, which is fear of missing out. But again, things look like they're heading in the right direction. One of the things that we got wrong, at the beginning of the year, we kind of put out some thoughts where we thought the market would be this year, and a lot of them we're pretty close on so far. But one, we thought we'd see more volatility in the first half of this year, and that just really hasn't happened at all. In fact, if you look at last year, let's see if I can get my cursor here. We had 23 days of 2% moves plus or minus moves. I'm sorry, 23 days of plus 2%, 23 days of minus 2, so 46 days we had a movement of 2% or more one way or the other. So far this year we've had 2. And usually when you have less volatility like that, you go back to 2017, 2019, as you can see in the chart, we're very low years. You tend to have pretty good returns. It's about 17%, as you can see on the right-hand side there. That's 10 days or less. We're only halfway through, so a lot can happen in the second half. But if we hold the trend and we can finish the year with less than 10 days of a plus or minus 2% move, that should bode well. I know we're probably close to that 17% now, but it tends to be a positive environment for markets going forward. And last one on just kind of where we're at in the second half. I don't know if anybody remembers this chart, but we break it out about every 4 years. It's the fact that come midterm elections, the markets tend to look pretty good in the next 12 months. So we had the elections on October 8th of 2022, and the pattern's been holding. We're up about 19.2% as of yesterday. So, again, from a sentiment standpoint or from a historical standpoint, markets tend to do pretty well after midterm elections, and that trend seems to be holding so far this year. Again, we have a few months left to get back to October, but so far so good. So keep that in mind as well. some thoughts on the economy, but I want to pause right there for a second, John. I don't know if there's any questions or if you have any thoughts.
No questions, but you mentioned 2017 with low volatility, and I remember it well. Low volatility, hot summer, great combination.
Yeah.
But going back to the new bull market slide,
Mhm.
and you and I have chatted a bit about different definitions. There are those who believe we have to break through the prior high, which is 4,800, not too far from here.
Right.
But regardless, if we have entered a new bull market, as the slide suggests, that is with the S&P 500 and 5 stocks, 7 stocks, the marvelous wonders of the world driving the market, while over 400 of them are kind of plodding along at 6-7% up, but not confirming the bull market on their own. So I guess my question is, will that group at some point, if we have entered a bull market, have to participate, or will they come kicking and screaming into the bull market with these big stocks dragging them? And maybe we received confirmation this morning with JP Morgan and confirming with the bank's results and so forth. But, what about those other 400 and some stocks? Do we expect them to the bull market to broaden out, I guess, is the question.
Yeah. So I'm gonna push back on you because I think we are seeing that already. So if you go back just the last 6 weeks. So if you go back from May 30th to where we're at today, technology has actually underperformed the S&P the last 6 months or last 6 weeks. Sorry, industrials, materials, consumer discretionary, communication services have all outperformed tech over the last 6 weeks. So we're seeing that broadening out already. I went back and looked at some data from Ned Davis Research, who has more charts than you can keep track of, but 40% of the S&P 500 was at a 20-day high yesterday. So you're seeing that broadening out. 84% of the S&P 500 names, so over 400 names, are above the 50-day moving average. And the 50-day moving average trend is positive, so that's good as well. And 85% of them are above the 10-day moving average. So I think you're seeing that broadening out. It's early. You still have those 5 or 6 that are definitely moving, and I think they're still market leadership. But you're definitely seeing the broadening out. The advanced decline line has hit a new high recently. That's usually a good sign that more stocks are going up than down. So probably more wood to chop there, so to speak. But I definitely think we're seeing that broadening out. I think to your point with the financials, we haven't really seen that in financials. They're a little weak today. What they call the KRE, which is the regional bank index, which is more the smaller banks, or the mid-sized banks, I should say, has been struggling. That seems to be continuing. We've been able to see a market move up here with at least one sector, which would be the financials not really participating. So, JP Morgan is probably the one shining star out of that group so far. The rest of them have struggled, but that could change in the second half. I think a lot of that, and you and I were talking about this earlier, is probably tied to rates and the direction of rates. So we'll see where that goes. But I'm hopeful that this breadth of the market will continue to expand. I think to your point, we probably need that if this market's going to move higher into the year end. If we just keep it in a very small group, market could potentially go up. I think it's harder and harder as you move forward. With you need more people rowing the boat than just 2 or 3 of them. So,
yeah. Makes sense.
It looks like that's happening. So,
all right, thank you.
Yeah, no problem. As far as the economy goes, and I've showed these charts before, but just to kind of keep everybody up to date, I definitely think we are in an environment where the economy is slowing. I guess the question really is it a soft landing or is it a recession that we're slowing towards? And that's a tough one. I think it's a little bit up in the air right now, but I think there's some indicators going in different directions, but I'll touch on a few of the ones that we watch. So, GDP for the first quarter was revised up from 1.3 to 2%. So the first quarter was a little stronger than I think most people thought. We're still below trend, which is that long-term 2% line. Year over year is 1.8%. So we'll see how it goes. But really, when you're below trend, that tends to be a good deflationary environment, and we are seeing inflation come down, as we saw earlier this week. As far as the second quarter goes, the Atlanta Fed, which is the most accurate of the forecasters out there, has a 2.3% GDP growth in the second quarter. So again, we're going to see the second quarter remain positive. A lot of banks, our street analysts out there, from JP Morgan to Evercore ISI to a couple others, have started to raise their second quarter estimates and even raising the third quarter estimates. So again, that view of the economy going into recession, which at the beginning of the year was some time ago a first half story, is now at least a second half story, but maybe even more likely a 2024 story. So it's holding up pretty well. The one thing that we've been keeping a close eye on from the investment team is the company surveys. They tend to be a very good indicator of recessions, and they tend to be a good real-time indicator. And that line in the sand is usually around 45. Right now we're at 53, and as you can see here, you're seeing a little bit of a pickup. So we were down around 50, it's picked up to about 53. If we get down below 50 and we're trending towards 45, I think that's another sign that we're definitely entering a soft patch. Again, is that a soft landing or a recession? I think we're still kind of in a wait and see mode. But other things like the New York Federal Reserve Bank, they have a model they use, which has historically been pretty good in indicating recessions, and it's well above that 45% level where it has to be. So it's up in the high 60s, so that it's predicting a recession. The yield curve's inverted, which tends to predict recessions in the future. So a lot of different dueling data points out there, but I think we'll get more clarity as we get into the second half of the year. And then, the last few I just want to point out, the one thing that was pretty strong this year has been job growth and maintaining a fairly high new jobs every month. But I think it's starting to slow down a little bit. The 3-month moving average is starting to come down a little. We saw a slower downtick this most recent one, where we were had positive gains of 209. But I think we're going to have to see that continue to go down. I think the Fed wants to see it to continue to go down. They want to make sure the economy is slowing. Wages are being contained. So we'll see. But I think we're finally starting to see that. But on the inflation side, the things that have been pushing inflation up are starting to roll over. One of them is used car prices, as you can see by the Manheim used vehicle index here. It's come down. I think it's going to continue to come down. There's something called owner's equivalent rent out there, which has been a large portion of the consumer price index, which is a measure of inflation, and that's coming down. Finally, it's a little sticky. It tends to be have a lag or delay to it, but it's starting to come down as well. So I think we saw a drop to 3% on inflation earlier this week. I don't know if we'll get much further in the next few months, but I think we're going to see a 2-handle on it pretty close. Fed's likely going to raise rates, but at some point in time, I think anything below 3% is going to be kind of where they think we land, and I think they'll soften up a little bit on their 2% target. So that's the economy. We can kind of shift into the markets. I don't know if there's anything out there as far as questions or any comments you have, John, or thoughts on the markets.
One question on short-term rates, and a lot of our clients have deposits in the banks and have been taking advantage of some of these short-term treasury rates, right? T-bill rates at 5% plus.
Yep.
And yet our clients know the longer-term rates are lower. Mm-hmm. So it's really enticing to go and buy a 1-year, 6-month T-bill and so forth. versus that longer term, 3.6% 5-year or whatever, or 3.8% 3-year. But do our clients, our investors, do investors in general risk getting caught in what you hear as the cash trap of having everything too short term? And I guess I would say, how are we positioning our clients for that? And the final follow-up question to that, can we have a bull market in bonds coming off the worst bear market in one of them in history? Can we have a bull market in bonds and stocks going forward from here?
So there's a lot of questions in there. I'll start from the beginning if I can remember them all. But I think, well, I guess where we're at today. So, I think we've lengthened our duration a little bit, but we're still overall we're still short duration relative to the ag, which is I think they call it the Bloomberg ag now, which is a pretty widely used bond index out there. So we're still short that index as far as duration, meaning our maturities are shorter than the duration of the index, and that tends to give you a little more protection against rising rates. So we're still short duration. I think we're going to probably be in that position for a while. We may, again, look to lengthen it a little bit, but the cash trap thing. I don't know if I agree with the way that it's portrayed. I guess I'm looking at rates, and Rick D'Amico is our fixed income head of fixed income, so I defer to him on these things. But we have had discussion as a team, and I think there's a couple things. One, you're getting 3 points. I think today it's 3.8% on a 10-year. You're getting 5+% on a 6-month or a 5-month, somewhere in that range. You can go a little shorter if you want, but somewhere in that range. And to go back to buying a longer duration, a 10-year treasury at 3.8, to make up that difference in yield, you have to hope for rates to come down, right? And you have to hope for them to come down relatively, sizable amount, 50 basis points or something like that, which, probably means we're in a recession, or the Fed's cutting rates, they're not pausing. So I think we're kind of far from that. They're going to raise rates in July, so you have at least one more Fed rate hike, probably 25 basis points. I think it's either next week or the week after they meet. And then they, the one the odds on that one, by the way, is about 95% as of this morning. So I would be shocked if they didn't raise rates this month. And then the second one that they've talked about raising, and Mary Daly, who's one of the Fed presidents, was talking about this yesterday, would be in September. There's not an August meeting, and that one's still up in the air, but it's about 25%, I think, chance that they're going to raise there. So I think there's still time. I wouldn't be getting longer in duration at this point yet. I understand the point. You don't want to be too short, too long, but I think it's a little early to be worried about that at this point.
Makes sense. Thank you.
Yeah, was there another one in there? Did I get them all?
Yeah, you did. Thank you.
All right. I know you rattled a few of them off, and I was trying to make sure I got all of them. But yeah, I think big picture, we're still on the short end of duration. I think we've lengthened a little bit. I think we'll keep that. That's probably going to be pretty flexible, and we'll keep that as we go forward. It's our belief they're going to raise rates 25 basis points this month. We still like that short end of the curve. If you look at places like Strategic Research, they still think that's the most attractive end of the most attractive part of the yield curve, and I think it's hard to argue that it's not. I think if we start to see signs of a slowing economy and the Fed pausing and maybe even shifting towards that rate cut, and just to kind of close the circle, the odds of a rate cut being over 50% isn't until March of next year. So we have some time in between here and there. If those numbers hold, and they tend to move. So that's where they're at today. So I'm going to jump into the markets. Valuations have definitely bounced in here. We're well above long-term averages. We're trading around 19 times earnings. Valuations are somewhat of a concern. I wouldn't disagree with that. I think that on the high end, we could get up to 20 times earnings. I think we're going to somewhere settle in between 17 and 18 times, which means we have to see earnings hold up a little better than we think going forward. Right now, and John mentioned, we just really kicked off earnings today with JP Morgan and a couple other banks. So we'll really get into the swing of things as we get in the next couple of weeks. But second quarter earnings are projected to drop about 7%. I think they won't do as bad. I think maybe 4 or 5%, maybe a little less than that is probably more likely. But this might be the worst of it. And I think going forward, earnings going forward we'll see be more flat going into what will be then the third quarter. But yeah, definitely something we're keeping a close eye on valuations. The dollar continues to weaken. In fact, this chart's only 3 days old, but it's already broken that trend line. We're down below what was the previous low there back in, I think it was May. So the dollar continues to weaken. It tends to be good for commodity prices because all commodity prices are priced in dollars, oil being the big one there. But I think the profits of the multinationals out there, like Procter and Gamble of the world that sell overseas, Microsoft, other ones, that could be a tailwind going forward because we'll have to translate those foreign currencies back to dollars, and that tends to be beneficial. And then the other, I think, benefit of a weakening dollar is owning overseas equities. So if you own international equities, it tends to do well. Specifically, as you can see in this chart, emerging markets. So that, I don't know what you call pinkish color column there. If you get since 1988, if the dollar's falling versus rising, it kind of gives you a breakdown of the returns of both U.S. Domestic equities, the developed international, and then emerging markets. And the emerging markets tend to do a little better. I know right now China's struggling, but India is doing pretty well right now. So it's something we're looking at going forward. The big second half question, the second half questions of this year is the budget issue. We still have to get a budget, so that's something out there. The Fed, and when are they going to stop raising rates? I think we're close. I think we're getting close to the end. As you can see in this chart, the Fed tends to keep raising rates until the Fed funds rate's above CPI. Well, Fed funds rate went up to 5.25%. And as of a few days ago, inflation dropped to 3%. So we're in that zone. And I think that's why they're starting to talk about pausing and taking a more data dependent process to this. So as you can see in that red circle to the right there, the gap now between Fed funds rate and CPI or inflation has turned positive. A few months ago when we put this chart out, it was the exact opposite, where inflation was much higher than the Fed funds rate. So I think we're very close to being done. I think, like I said before, the July rate hike is pretty much factored in. But I think after that, that September, by the time we get to that September meeting, I think it's not going to be as cut and dry as some have anticipated. So we'll see. But I think we're very close to being done. We're very close to the Fed being done. 10-year treasuries, we've been flirting with that 4% for a while. We got a little over 4% about 2 weeks ago. We've come down a little bit. As John and I were talking earlier, 3.8% is where it was this morning. It was down to about almost 3.7 yesterday. So we'll see where it flushes out here. But if you look at the trend lines, it looks like it's breaking out, and we could see another push up towards 4%. So going back to your sector comments earlier, I think that's a bad environment for financials if we start to see that 10-year rate get back above 4%. But we'll see how that all works out. I think the break even point is at 425. If we break above that, then I think the trend is definitely higher. And this is I won't really dwell on this too much because I think we've already covered most of this, but returns by the mega cap names. So, they've been Microsoft, Google, Amazon, Meta for sure, Nvidia, Tesla. I think those are the 7 biggies that we've been talking about. I guess Apple will be another one of those. So the combined weight of the 5 largest names in the S&P are back above historical levels. So we're at 24%. So it's at the highest that we've seen it. We've talked about the breadth of the market. So I think it's definitely been it's an issue, but I think breadth is starting to expand here. So not too concerned. Oops. And then, I'll take a pause there, John. I don't know if there's any questions that come through, or if you have any thoughts, or Annika has any questions. But
Well, just one on going back to the AI, the slide on AI. We've all heard so much about artificial intelligence, and it's nothing new. But when Microsoft came on the scene in the first quarter, announcing ChatGPT and GPT and the success they had, and they do have real customers and real earnings around this. But how do we identify for clients that are interested here good opportunities with AI and avoid getting caught up in the hype that's going to end badly for many companies and many investors? So, how are we sifting through that right now for our clients?
so we have several names out there that have ties to the AI infrastructure, if you want to call it that. Broadcom's a good example of that. A semiconductor name. We own Microsoft, which has the Bing search engine, which uses the Chat GPT. Amazon is definitely getting more into that. Meta is a big player in artificial intelligence. So I think some of the mega cap names we own. As you want to get into that second layer or third layer down, where you're looking for those startups or smaller names or ones that are kind of breaking out, I would probably advocate using something like an ETF or a fund that kind of buys into those. There's one out there, ticker is AIQ, which has holds a bunch of different equities in it that are tied to artificial intelligence. And I actually was reading an article, and Ned Davis put out a research piece on which ones, because there's a bunch of them out there. Some have more are more closely tied to that than others, and that was one of the ones they recommended. So I think if you're looking to kind of throw a broad net out there and see what you can catch, and try to catch that next big wave, I think that's probably a better way of doing it. I think from a larger cap standpoint, I think we have a pretty good coverage of those for the names I mentioned before. Apple just came out with their I forget what they call their headset, but Vision Quest or something like that. So Meta has theirs. So I think I don't think AI and how we use it is going away. It's going to be a tool that people will use more and more in their life. Try to help them either make things more efficient or quicker. I made the joke at the beginning about writing term papers, but you can write job descriptions and things like that, and it'll start small, but I think it's something that's going to continue to progress. I hope we don't get to the point in Terminator where they run the world, but we'll see. So I think there's a couple options out there, but if anybody wanted to talk more about that, I'm happy to jump on a call with them, or maybe somebody on the investment team as well. So happy to do that. We can set that up through your advisor, not a big deal.
Thanks.
So as far as portfolio goes, I know. So we talked a lot about sectors earlier, and obviously technology has been the big winner so far this year. But as I mentioned, recently discretionary has done pretty well. Financials are still struggling. So as we try to position our portfolios and sometimes it's moving a steam tanker here. You can't move these overnight, but just as we look at the markets out there, we've been adding to technology and discretionary names. You can see industrials have done really well over the last 5 or 6 weeks, materials as well. So we've been overweight industrials, consumer discretionary materials. We're looking to add to information technology. But as you look at the bottom part of that screen, really the names I've mentioned are cyclical names. The ones that are on the bottom tend to be those defense-oriented names. So utilities, healthcare, financials are struggling, real estate as well. So I think we've definitely started to shift back towards a cyclical bias within the portfolios. And I don't see that changing. If we do see a recession in the second half of the year or into early 2024, and it tends to be a little more than a mild type recession, that might be something we take another look at. But as we stand today, I think being positioned in a cyclical basis has benefited us so far, and I think will continue in the second half of the year. Small caps are starting to this goes back to that breadth of the market and seeing more and more participation, but small caps look like they're bouncing off support there. So this is a Ned Davis chart that shows small caps versus large caps, and as it goes down, small caps are underperforming. If it turns up, like we saw back in January of 20 or back into late 2020, then small caps are doing better. So we've bottomed here. We had a big rally into 2020. Looks like maybe we're forming another bottom here, and we can see it rally again versus large caps. But again, I think that kind of goes back to the conversation about expanding breadth in the market to do that. So if you look at it historically speaking, the third quarter tends to be one of the more muted quarters, meaning returns are kind of flat. We're in that period here where the forward 3-month returns are pretty flat. So as we get into this summer doldrums or the end in May, and the old end in May and go away, I'm not a big believer in that. But as we get into that summer period, returns tend to slow. And then as we get back into the fall and the fourth quarter, you start to see better returns on a 3-month adjusted basis. So could see some consolidations. My guess is at some point here, John, we're going to see some type of pullback, 3%, 5%. I mean, markets have run pretty good. We're going to get through earnings season. You're going to get to a point where maybe you expect too much and they under deliver. Not that that's bad, but just a shorter term thing. So we could see a pullback. I would be of the opinion that you want to buy that dip if we see a 3 or 5% consolidation or correction over the next couple months. And you tend to get those every year. I've made this statement before, but you tend to have 3-5% corrections a year and 1-10% correction a year. It doesn't work in a straight line, so you don't always get them that way, but that tends to be the averages. So getting a 5% correction at some point in the next few months wouldn't be surprising to me. So that's kind of the thoughts. I mean, I got a couple slides on what we're watching going forward, but any comments, thoughts, questions?
No more coming through. You could move ahead with that, John.
All right, sounds good. So again, I think my thought, we said earlier in the year when we kind of put out our thoughts for the year. My neighbor's cutting the grass, so you might hear him. As we put out our thoughts earlier in the year, we thought we'd see positive returns in the equity markets. We thought we'd see positive returns in the bond market. I didn't think they would be large double-digit returns, but so far that's kind of where we're at with the S&P. But as I mentioned earlier, I'm kind of a glass half full person at this point. I think there's some upside. There's a lot of money on the sidelines, as we mentioned, $7 trillion in money market out there. I don't know if there's the fear of missing out or the FOMO trade kicks in at some point. That's possible. I think our view is closely watching the economy for signs that we are falling into that recession, if in fact that happens, or the soft landing that the Fed would prefer. And then obviously watching the Fed and their decisions on monetary policy. But I'm fairly certain we're very close to the end, if not one more, maybe perhaps two more. But I think we're close to the end on that one. So a couple of things, we can discuss if it's a bear market or not, but I'm going to make the assumption the bear market ended on October 12th, as you can see here. Historically speaking, once the bear markets end, and we're up about, I think I said 28% from there. 1 year returns off that low tend to be pretty good. We're at 28% already. The average or the median's about 34. And then 2 years later, you still have a pretty positive return. In fact, it's been positive every time. It's about 57% return. So even if we just went to the historical averages, we got further upside to go. Doesn't mean we won't see pullbacks, doesn't mean we won't see some consolidations. And, the wall of worry will still exist, and I'm sure there'll be issues. We have the budget deficit or the budget deal, some type of budget deal has to be done here pretty soon as we get into September. So plenty of things to be concerned about. And the other one is, we talked about used car prices, but one of the things about the pandemic was we ran out of chips, right? All the semiconductor chips, and no one could get cars, and the cars were all sitting in lots without chips in them. We're starting to see that pick up a little bit, but we are at levels where we haven't seen in a while as far as the age of cars on the road. So, I don't know if we'll do another cash for clunkers. I don't think that might have been a one-time event, but I think we're going to see autos pick up. So that's one thing that could propel the market going forward. And, people trading in their cars, so auto sales. And then the other one, I think, and I'll talk about in a second, we'll jump forward, is housing. I know mortgages are up to 7% or pretty close to it, so a lot of concern there. But the average housing inventories are really low. They're just not building new houses at the speed they were in the past. And I can only speak for my neighborhood here in Ohio. When houses go on the market, they go fast. So we could see a point where the housing market picks up, new housing starts to pick up. That tends to be a pretty good indicator for the economy, as someone mentioned before. If you build a new house and you buy it, you got to furnish it, you got to put a yard in, so it has a lot of other things that help. So both autos and housing look like we're in areas where we can see benefits going forward. So that's really about it. Happy to take any questions. I kind of want to just throw it out there. I say this every time, but I appreciate all the help we get from the investment team for us putting this together. Obviously, the questions from advisors like John and our colleagues, and obviously Annika and the marketing team for helping us put it together. I guess my last thing I'll say, John, and I've said this before, but if you ever want to get a hold of us, we're happy to have a conversation. If you guys want to talk to your advisor about having a conversation about anything we talked about today, myself or anybody else on the investment team is happy to jump on a call. We do WebExes all the time with clients, so feel free to reach out.
Thank you, John. That's right. John is always available for a joint call if you'd like to pick his brain and as part of our meetings. So if you have any follow-up questions, feel free to reach out to your advisor, and they will connect with John's investment team, and we'll reach out to you directly. I want to thank you for joining us today. It is really our privilege to work with you and your family, and we really feel sincere gratitude and trust and loyalty towards you for that. We wish you a great summer. Enjoy your summer. I hope it's a hot one with low volatility like 2017 for us all. And we'll leave you with that. Thank you very much.
Thanks.